Yo, what's up everybody, it's Jake, and welcome back to the channel. Today we're diving into a crucial topic for any investor: stocks versus mutual funds. Look, I get it. Figuring out where to put your money can be confusing, and you're probably hearing a lot of different opinions out there. That's why I want to break down the pros and cons of each of these investment vehicles in simple terms, so you can make an informed decision that aligns with your financial goals. Whether you're just starting out or you've been investing for a while, this video is definitely for you. So grab your coffee, smash that like button for the YouTube algorithm, and let's get started. Alright, let's break down stocks first. When you buy a stock, you're essentially buying a tiny piece of ownership in a publicly traded company. This means you have a stake in the company's future and its potential success. Think of it like owning a single brick in a massive skyscraper. Each brick is crucial to the structure. Just as each share contributes to the company's overall value, you're a part owner, even if it's a very small part. This ownership gives you certain rights, such as voting on important company decisions. Now, why would you want to own a piece of a company? The reasons are compelling and multifaceted. Well, there are two main reasons: potential growth and dividends. These are the primary ways you can benefit financially from your investment. When a company performs well, its value increases, and as a shareholder you get to participate in that growth. This can lead to significant financial gains over time. Your little brick becomes more valuable. This increase in value is reflected in the rising price of the stock. This is what people mean when they talk about stocks going up. It's a sign that the company is doing well, and that your investment is growing. Dividends are like bonuses paid out to shareholders from the company's profits. They provide a steady income stream in addition to the potential for capital gains. Not all companies pay dividends, but some do, and it's essentially a way for you to share in their success. It's a tangible reward for your investment. It's like getting a little rent check for owning that brick in our skyscraper example. This can be a reliable source of income, especially from well-established companies. Now, let's talk about the potential advantages of investing in individual stocks. These benefits can make stock investing an attractive option for many. First and foremost, you have the potential for higher returns compared to more conservative investments. This potential for growth is a key reason many people invest in stocks. The stock market has historically outperformed other asset classes over the long term. This historical performance can provide confidence in the potential for future gains. Second, you have complete control over your investments. This autonomy allows you to tailor your portfolio to your personal beliefs and financial goals. You get to choose which companies you believe in and want to invest in. This can be empowering and allows you to support businesses that align with your values. You're not relying on someone else to make those decisions for you. This independence can be both rewarding and challenging. And third, stocks offer a high degree of liquidity. This means you can easily buy and sell your shares on the stock market whenever you need to, providing flexibility. This means you can easily buy and sell your shares on the stock market whenever you need to. This liquidity is a significant advantage over other types of investments. Of course, this liquidity depends on the specific stock and market conditions, but generally speaking, it's relatively easy to cash out your investment if you need to. This can be crucial in times of financial need. However, it's not all sunshine and rainbows with individual stocks. There are risks involved, and it's important to be aware of them. Understanding these risks can help you make more informed investment decisions. The most significant risk is the potential for volatility. Stock prices can be highly unpredictable and can change rapidly. The stock market can be unpredictable, and stock prices can fluctuate significantly in the short term. This volatility can lead to substantial gains or losses. This means you could lose money if you need to sell your stocks during a downturn. Timing your sales can be critical to avoid losses. Another risk is the potential for poor stock selection. Choosing the wrong stocks can lead to significant financial losses. Picking individual stocks can be challenging, even for experienced investors. It requires a deep understanding of the market and the companies you're investing in. It requires research, analysis, and a bit of luck. Even with thorough research, there's no guarantee of success. If you're not careful, you could end up investing in companies that don't perform well, and you could lose money. This risk underscores the importance of due diligence. Finally, investing in individual stocks requires time and effort. You need to stay informed and continuously monitor your investments. You need to research companies, track their performance, and stay up to date on market trends. This ongoing effort can be time-consuming. If you're not willing to put in the work, you might be better off considering other investment options. There are many ways to invest that require less hands-on management. Now let's address two crucial concepts when it comes to investing in stocks: diversification and market timing. These strategies can help manage risk and optimize returns. Diversification is the idea of spreading your investments across different asset classes, sectors, and geographies. This strategy helps to mitigate risk. The goal is to reduce your overall risk. By diversifying, you can protect your portfolio from the poor performance of any single investment. By not putting all your eggs in one basket, you're less likely to be wiped out if one particular investment performs poorly. This approach can provide more stable returns. Think of it like this: if you invest all your money in a single company and that company goes bankrupt, you lose everything. Diversification helps to avoid this scenario. But if you diversify your portfolio across multiple companies, sectors, and asset classes, the impact of one bad investment is minimized. This can lead to more consistent performance. Market timing, on the other hand, is the attempt to predict when to buy and sell stocks to maximize returns. This strategy is often more challenging than it sounds. It's the idea of trying to time the market and buy low, sell high. While this concept is appealing, it's notoriously difficult to execute successfully. While it sounds tempting, market timing is incredibly difficult, even for professional investors. The market's movements are influenced by countless factors, many of which are unpredictable. The reality is, it's nearly impossible to consistently predict market movements. Even experts with years of experience often get it wrong. Even the most experienced investors get it wrong all the time. This unpredictability makes market timing a risky strategy. Trying to time the market often leads to buying high and selling low, which is the opposite of what you want to do. This can result in significant financial losses. So, instead of trying to time the market, focus on time in the market. This long-term approach can help you ride out short-term volatility. The longer you stay invested, the more time you have for your investments to grow and compound. This compounding effect can significantly enhance your returns over time. Remember, investing is a marathon, not a sprint. Patience and persistence are key to achieving long-term financial success. Now, let's move on to mutual funds. These investment vehicles have become incredibly popular over the years, and for good reason. A mutual fund is essentially a basket of stocks, bonds, or other assets that are pooled together and managed by a professional fund manager. This allows individual investors to access a diversified portfolio without having to buy each asset individually. When you invest in a mutual fund, you're buying a share of that entire basket of assets. This means you own a small piece of each asset within the fund, giving you a diversified investment with just one purchase. Think of it like this. Imagine you want to invest in real estate, but you don't have enough money to buy an entire apartment building. The cost and complexity can be overwhelming for a single investor. Instead, you could pool your money with other investors and buy a small piece of that building together. This way, you share both the costs and the potential returns. That's essentially what a mutual fund does, but with stocks, bonds, or other assets. It allows you to invest in a diversified portfolio without needing a large amount of capital. One of the biggest advantages of mutual funds is instant diversification. This means your investment is spread across a variety of assets, reducing the risk associated with any single investment. By investing in a single mutual fund, you gain exposure to a wide range of assets, which helps reduce your overall risk. This is particularly useful in volatile markets where individual asset performance can be unpredictable. This is especially beneficial for investors who are just starting out and may not have enough capital to build a diversified portfolio on their own. Mutual funds provide an accessible entry point into the world of investing. Another advantage is professional management. This means that your investments are being handled by experts who have the knowledge and experience to make informed decisions. When you invest in a mutual fund, you're essentially hiring a professional fund manager to make investment decisions on your behalf. This can be a huge benefit for those who don't have the time or expertise to manage their own investments. These managers have years of experience, access to research and data, and the expertise to navigate the complexities of the market. They can make strategic decisions to help maximize your returns. However, it's important to note that not all mutual funds are created equal. Each fund has its own unique characteristics, and it's crucial to understand these before investing. They come in all shapes and sizes, each with its own investment objectives, risk profile, and fee structure. Understanding these differences can help you choose the right fund for your needs. Let's break down some of the most common types of mutual funds. 1. Equity funds. These funds invest primarily in stocks and are designed for investors seeking long-term growth potential. These funds invest primarily in stocks and are designed for investors seeking long-term growth potential. They offer the potential for higher returns, but also come with higher volatility. 2. Bond funds. These funds invest primarily in bonds, which are less risky than stocks. They're a good option for investors seeking income or capital preservation. 3. Index funds. These funds track a specific market index such as the S&P 500. They offer broad market exposure at a low cost. 4. Target date funds. These funds are designed for investors saving for retirement. They automatically adjust their asset allocation as you get closer to your retirement date, becoming more conservative over time. This makes them a convenient option for long-term retirement planning. When choosing a mutual fund, it's essential to consider your investment goals, risk tolerance, and time horizon. These factors will help you determine which type of fund is best suited for your needs. You should also pay close attention to the fund's expense ratio, which is the annual fee charged to investors to cover the fund's operating costs. Lower expense ratios can lead to higher net returns over time. Now let's talk about the tax implications of investing in mutual funds. Taxes can have a significant impact on your overall returns, so it's important to understand how they work. One of the downsides of mutual funds is that they can be tax inefficient. This is because mutual funds distribute capital gains to investors throughout the year, even if you don't sell your shares. These distributions are taxable, which can eat into your returns. However, there are ways to minimize the tax impact of mutual fund investing. One strategy is to invest in tax-efficient mutual funds, such as index funds or exchange-traded funds, ETFs. These funds tend to have lower turnover rates, which means they generate fewer taxable capital gains. Another strategy is to hold your mutual funds in a tax-advantaged account, such as a 401k or IRA. These accounts offer tax benefits that can help you save money on your taxes. By understanding the different types of mutual funds and their tax implications, you can make more informed investment decisions. So, which is right for you, stocks or mutual funds? This is a common question for many investors. It all depends on your financial goals, risk tolerance, and investment horizon, and how much time you want to spend managing your investments. Some people enjoy the hands-on approach while others prefer a more passive strategy. Remember, a balanced portfolio often includes both. Diversification can help manage risk. If you're comfortable with a bit more risk and want the potential for higher returns, investing in individual stocks might be a good option for you. Stocks can offer significant growth opportunities. Just remember to do your research, diversify your portfolio, and stay informed about market trends, and avoid trying to time the market. Timing the market can be risky and often leads to losses. If you prefer a more hands-off approach and want instant diversification, mutual funds could be a better fit. They offer professional management and a diversified portfolio. Just make sure to choose funds that align with your investment goals and risk tolerance, and pay attention to the expense ratios. High fees can eat into your returns. Thanks for watching, and don't forget to like, subscribe, and hit the bell for more investing tips. Stay tuned for more insights.